So there is this one piece of investment advice that is basically plastered on every finance blog, every Reddit forum, and an Instagram reel out there.
Oh, yeah. It's everywhere.
It's just three simple words. You've definitely heard it. Invest in what you know.
The golden rule.
Mm.
Or at least the most famous one in the history of the stock market.
Right. And on the surface, I mean, it sounds incredibly empowering. It sounds like permission to just buy stocks in companies you already like as a consumer.
Exactly. Like, I drink 3 lattes a day. I love this coffee shop, so...
So I should buy the stock and get rich.
Yeah, and that is exactly how people lose a lot of money.
Well, that is a cheerful way to start our deep dive today. But seriously, that's the trap, right?
It's a huge trap. If you think Peter Lynch, the legend who ran the Magellan Fund and returned, what, 29% a year for over a decade?
29%. Unbelievable run.
Right. If you think he was just buying brands because he liked the taste of their donuts, you're missing about 90% of his actual strategy.
And that's exactly what we're digging into today, because for this deep dive, we've pulled apart Lynch's books, specifically One Up on Wall Street, along with a stack of analyses on his actual methodology.
Which is so needed because people misinterpret him constantly.
Our mission today is basically myth-busting. We are going to replace that whole buy what you like mentality with his actual framework, which is start with what you know, then prove it with the numbers.
Right. Lynch didn't use personal experience as a substitute for research. That's the key. He used it as a filter to find leads.
So for everyone listening, we're going to walk you through the 5 specific steps he recommended, taking a hunch from the grocery aisle all the way to an actual valuation model.
Let's do it. Step 1 is spotting the trend from your edge.
The edge. Lynch had this theory that the average person, you, me, the listener on their commute right now, actually has a massive advantage over Wall Street analysts.
He really believed that. And it sounds counterintuitive, right? Because we're all conditioned to think Wall Street has all the power. They have the Bloomberg terminals.
The high-frequency algorithms, the Ivy League research teams.
Exactly. But Lynch argued that by the time data hits a Bloomberg terminal, it's already history.
It's completely backward-looking.
Precisely. Wall Street is analyzing what has happened. But as a consumer or a professional out in the real world, you are seeing what is happening right now.
You're seeing the future cash flows before they ever hit a spreadsheet.
Lynch called this local knowledge.
Yeah, our sources actually use the term scuttlebutt, which, I don't know, it feels very old school spy novel to me.
It does. But it fits perfectly. It's effectively proprietary intelligence. Lynch used to talk about how he found some of his biggest winners, like Taco Bell, Dunkin' Donuts, Hanes, not by screening for PE ratios, but just by driving around.
The Hanes story is classic. It wasn't that he, loved pantyhose personally.
Right.
It was that he noticed legs were suddenly being sold in grocery stores, not just department stores.
Which is a massive business shift.
Yeah.
That's a total distribution game changer.
Exactly. He saw women buying them repeatedly right along with their milk and bread. That is high-frequency recurring revenue right there.
And he saw that inventory turnover with his own eyes months before the quarterly report came out and Wall Street caught on.
And that actually brings up a key distinction in the research. There's the consumer edge, which is what we just described, seeing a busy store or a product flying off the shelves.
Right.
But then there's the professional edge. And honestly, I think the professional edge is where the real money is made for individual investors.
Oh, without a doubt. It's the idea that your 9-to-5 job is actually your best research lab.
Yes, because most people try to invest in industries they know absolutely nothing about. Doctors try to buy oil futures, tech guys try to day trade biotech.
And Lynch says, just stop. Look at your own desk. Look at your own industry.
If you're a nurse or a surgeon, you know exactly which medical devices are actually working on the floor.
You see what the surgeons are literally fighting over in the operating room.
Right. If the hospital procurement department is suddenly ordering pallets of a new specific catheter or stent, and the doctors are saying, I refuse to use anything else.
That is gold. That is what we call early data on demand. You are seeing a moat forming in real time.
Let's actually pause on that word moat, because we throw it around a lot in finance.
Yeah.
In this context, the moat is the stickiness of the product, right?
Exactly. It's the competitive advantage.
Yeah.
Let's use an IT example, which is great for a lot of our modern listeners.
Okay.
Say your company decides to migrate its entire cybersecurity infrastructure to a new vendor.
Oh, man, the pain involved in that.
Exactly. The training, the integration.
It's a complete nightmare. Nobody wants to switch once they're settled in.
But if the engineers are saying this new tool is the only thing that actually stops the attacks and management signs a 5-year contract,
Wall Street won't see that revenue stability for months, but you see it today.
you lived it today. So the signal isn't just, hey, I like this software,
The signal is this is backordered, or this is dominating shelf space.
or my boss just signed a check for $1 million for this because we literally can't run the business without it.
Correct. But, and here is where the rubber meets the road, that is only step one. That's just the lead.
And sadly, that's where most people stop. They buy the stock right then and cross their fingers.
Which brings us to step two, translating that observation into an actual business hypothesis. Because a cool product does not always equal a good business.
They're rarely the same thing, honestly. You have to pivot your brain from consumer mode to analyst mode. You need to articulate why this observation leads to profit.
So how do we do that? Like, if I see that everyone in my neighborhood is suddenly wearing a certain brand of running shoes, how do I turn that into a business hypothesis?
You look for the mechanics of the business.
Hmm.
We mentioned moats earlier. Person experience is actually way better at identifying qualitative moats than Wall Street surveys are. Think about switching costs.
Switching costs being how hard it is to stop using the product once you start.
Right, going back to the software example, if you hear your colleagues say, if management tries to make us go back to the old system, I'm quitting, that's a massive insight.
That tells you the product has real emotional and workflow dependence.
Exactly. Wall Street analysts try to guess retention rates from a spreadsheet. You are living them in the office.
Okay, but what about execution? Because a company can have a great product and still just be a complete disaster operationally.
Oh, absolutely. But you can spot that too from your edge. If you order that hot new product and it arrives 3 weeks late, broken, and customer service leaves you on hold for 2 hours.
That's a huge red flag.
It's a massive siren.
Yep.
This is just supply chain issues, poor management, or severe scaling problems.
If you have a great product but you can't deliver it, you don't have a business.
Exactly. You can spot the cracks in the foundation way before the earnings call reveals a massive miss.
So before we even open up a stock chart, we need to be able to make a clear qualitative statement. Something like, this firm is gaining market share in this specific procedure because the product saves time and hospitals are standardizing on it.
That is your hypothesis. Now you have to try and break it. Which brings us to step 3.
Step 3, the part everyone desperately wants to skip, do the basic math.
Lynch calls this 4th grade math.
Which is comforting, but let's be honest, for a lot of people listening, opening a balance sheet feels like reading Greek. Why does Lynch insist on this? Can't I just trust the trend I saw with my own eyes?
No, you can't. Because the trend might be entirely real, but the company might be going bankrupt anyway.
Right.
Lynch's point about 4th grade math is that you don't need complex calculus. You aren't building a discounted cash flow model. You just need to check if the engine is actually running.
Okay, so let's walk through the specific metrics he wants us to check. Imagine I found a retail chain that just seems packed every time I drive by. What is the very first number I look for?
First, verify the growth. Look at the revenue line over the last few years. Is it actually going up?
Or was your local experience just a weird anomaly?
Exactly.
Yeah.
Maybe your local Taco Bell is the only busy one in the state because the manager is giving away free tacos. You have to verify that the local reality matches the global reality.
That makes sense. Revenue growth is step 1.
Second, and this is critical proposition, check the profitability, specifically margins.
Define that for us. Why do margins matter more than just total sales?
Because sales are vanity, profit is sanity.
I love that.
Gross margin tells you how much it costs to simply make the product. Operating margin tells you how much cash is actually left over after paying the rent, the staff, the marketing.
So if a company is selling millions of dollars of product but losing money on every single sale,
They aren't growing, they're dying.
it's that classic joke, we lose money on every unit, but we make it up in volume.
Exactly. You want to see stable or expanding margins. That proves the company has pricing power. It proves people are willing to pay more than it costs to make.
Because if they have to discount everything just to move inventory, those margins will shrink fast.
You got it. So we check revenue, we check margins, and then there's the scary one, the balance sheet, specifically debt.
This is the one that kills the most amateur investors, isn't it?
Without a doubt. You need to see how all this amazing growth is being funded.
Explain the danger here. If a company is expanding rapidly, opening new stores, don't they naturally need to borrow money?
Sometimes. But there is good debt and there's bad debt. If a company has a mountain of debt and interest rates suddenly rise, their monthly payments skyrocket.
And if they have even one bad quarter, the bank can just pull the plug.
Exactly. Lynch loved companies with what he called fortress balance sheets. Lots of cash, very little debt. It gives them the staying power to survive their own mistakes.
So if I see a company that is growing 50% a year, but they have zero cash and billions in high-interest loans.
You run away. Fast. That is a ticking time bomb. The edge you spotted that really cool product doesn't matter at all if the bank repossesses the company.
Okay, got it. So we've spotted the edge. We've formed a solid business hypothesis. We've checked. The math sales are up. Margins are healthy. Debt is low. Now do we finally buy?
Nope. We are not there yet.
Come on, it's a great company.
It is a great company, but step 4 is finding out if it's a great stock. Step 4 is check the valuation, the price.
This is the distinction that I think is the absolute hardest for people to grasp. Liking the product is not the same as liking the stock.
It's the house in a great neighborhood analogy. You might find the perfect house. Great location, great school district, totally solid foundation.
But if the seller wants $10 million for a 2-bedroom cottage...
It's a terrible investment. You are drastically overpaying.
Right.
You have to look at what you are paying for that growth.
Yeah.
And we usually use metrics like the PE ratio, price to earnings.
Let's break down PE simply for the listener who might be glazing over at the acronyms.
Sure. Think of the PE ratio as the number of years it would take for the company to earn back your initial investment, assuming profits stayed exactly the same.
So if a stock costs $20 and it earns $1 per year, the PE is 20.
Correct.
So a lower PE is generally better. It means it's cheaper.
Generally, yes. But it's always relative to growth. Lynch was actually famous for using the PEG ratio, price to earnings to growth.
How does that work?
Essentially, he believed a company growing at 20% a year should trade at a PE of 20. But if it's trading at a PE of 50 and only growing at 10%,
then it's massively overpriced.
Grossly overpriced. And this leads directly to what we call the perfection trap.
Oh, the perfection trap. I really like this concept.
You find a stock that everyone loves, like a lot of the big tech darlings today, and it's trading at 80 or 90 times earnings. The market is pricing in absolute perfection. They are assuming nothing will ever go wrong.
So your edge, that secret scuttlebutt knowledge you thought you had about how good the product is, it's totally worthless. Because everyone else already knows it and they've already bid the price up.
Exactly. If the market expects 50% growth and the company delivers 40% growth, which is still amazing, by the way, the stock might actually crash.
Because it missed those sky-high expectations.
Right. You want to find the situations where your boots-on-the-ground knowledge tells you something the market hasn't fully priced in yet.
You want the diamond in the rough, the company that is performing great in the real world, but the market currently thinks is boring or risky.
That is where the alpha is. That's how you actually beat the index.
Okay, so assuming we pass the valuation check, the price is reasonable, the PEG ratio looks good, we are finally ready for step 5. And this is honestly my favorite part of the whole framework because it's a literal test you have to pass before you hit that buy button.
Lynch calls this the 2-minute drill.
It's so simple. You need to be able to articulate exactly why you own the stock in plain English to a child in under 2 minutes. And this is the absolute kicker. It cannot be because the coffee is good.
Right. Because the coffee is good is a consumer statement. The 2-minute drill requires an investor statement.
Our sources give a really specific template for this, and I want to just read it because it perfectly synthesizes everything we've talked about today.
Go for it.
Listen to this structure. I own this stock because it is a high-margin category leader in minimally invasive devices. It is gaining market share from competitors. It has a recurring revenue stream from consumables. And it is trading at a PE of 15, which assumes only moderate growth, despite the fact that they are growing at 20%.
That is a beautiful sentence.
It's dense, but it hits every single point.
It does. Look at what it covers. Category leader covers the moat. High margin covers the profitability check.
Recurring revenue covers the business model stability.
And trading at 15 PE covers the valuation check.
And the comparison market assumes moderate growth, but actual growth is higher. That identifies the actual opportunity, the mispricing.
Exactly. And if you cannot say a sentence like that about every single stock in your portfolio, Lynch would say you don't really know what you own. You're just gambling.
That is a harsh reality check for a lot of people listening right now.
It's meant to be. The stock market is not a casino, even though so many people treat it like one. When you buy a stock without this level of detail, you are effectively sitting down at a high-stakes poker table without even looking at your cards.
Speaking of gambling, Let's pivot and talk about the anti-portfolio. The common pitfalls where people think they are applying Lynch's advice, but they are actually just walking right off a cliff.
The biggest one, hands down, is confusing familiarity with safety.
Unpack that for us.
Just because a brand is famous, or just because you see it every single day, does not mean it is a safe investment. Think about airlines. You might fly a specific airline every single week for work. You know the brand, you know the routes, you like the miles program.
So I feel incredibly comfortable with it. I feel like I know it.
But that familiarity blinds you to the structural economics of the industry.
Yeah.
Airlines are notoriously terrible businesses.
Oh yeah, historically awful.
They are capital-intensive. Planes are ridiculously expensive. They are cyclical. They are heavily regulated. They have massive labor costs.
You can know an airline perfectly as a consumer and still lose 50% of your money just because the price of jet fuel went up.
Exactly. It's the Kodak problem, too. Right?
Kodak! Everyone knew Kodak. Everyone used Kodak film.
And that extreme familiarity made investors completely complacent. They missed the underlying technological shift that was destroying the business model right underneath the brand name.
Lynch warns us, don't let the comfort of a famous brand name stop you from checking the balance sheet. A famous company can go to zero just as easily as an obscure one.
Sometimes easier because they get bloated.
Another major pitfall mentioned in the sources is the whisper stock.
Ah, yes. The next big thing.
They're going to cure cancer, or they have a patent that will revolutionize green energy.
Lynch hated these. He called them long shots.
Yeah.
The problem here is that the story is so intoxicating that it totally bypasses the logic center of your brain.
You just think, wow, if this works, I'll be rich overnight.
But usually, they have absolutely no earnings.
No earnings, no revenue, usually just a prototype in a really slick PowerPoint deck.
Lynch's rule was very clear. Invest in companies that are already winning, not companies that might win someday.
Yes.
He wanted to see the earnings actually on the table.
So, invest in what you know really doesn't mean invest in what you hope will happen.
Perfectly said. It means invest in what you can observe happening right now, out in the world, backed by numbers that prove it's actually profitable.
It really just circles back to intense discipline. The fun part is the observation spotting the packed store or the cool new tech at work. The hard part, the part that actually makes you money over time, is the boring, impersonal analysis.
And that is the deep logic of this entire framework. You use your subjective life, your experiences, your daily job, your shopping habits to generate ideas that are honestly better than the average Wall Street analysts. But then you have to be ruthlessly objective when you vet them. You have to be willing to tear your own favorite ideas apart with a calculator.
So invest in what you know is really just the starting gun. It is definitely not the finish line.
That's it. It tells you exactly where to dig, but you still have to pick up the shovel and do the work.
I love that image. All right, so here is a challenge for everyone listening. We want you to try this framework out today.
Do it.
Look at the last 3 things you bought. Maybe it's a specific brand of yogurt you're totally obsessed with, a new pair of running shoes, or maybe that project management software you just forced your entire team to install at work.
Take those 3 items and run them through Lynch's filter. Don't just look at the product. Actually look up the ticker symbol.
Look at the revenue growth, look at the margins, look at the debt, look at the PE ratio.
And then ask yourself, if I had to stand up right now and give that 2-minute drill speech about this company, could I do it? Do I have a real business hypothesis, or am I just a fan of the product?
You might be really surprised by the answer. You might find that your favorite brand is actually a terrible stock.
Or you might just find your next 10-bagger sitting right there in your pantry.
And that is the Peter Lynch Edge. Thanks for taking this deep dive with us today.
Always a pleasure.